Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend, or I'll hit you in the face with a brick. What? I can't say that? Today I'll be showing you how to read candlestick charts. It's a very basic method, and you're going to have to know this if you're even going to consider technical analysis. So let me explain this to you. The Japanese began using technical analysis to trade rice in the 17th century. While this was an early version of technical analysis, it was different from the U.S. version initiated by Charles Dow around 1900. Many of the guiding principles are similar, but it's important to know that this comes from the Japanese, and therefore some of the things you'll learn later on about charts, you'll find Japanese names in them and you'll know why. In order to create a candlestick chart, you must have a data set that contains the opening price, the high price, the low of the day or the period, and the close of the price. Each time period you want to display is going to have all those four elements. It works much like a bar chart, but the candlestick chart is more visually appealing, easier to recognize patterns quickly, and that's why they're becoming so popular. The hollow or filled portion of the candlestick is called the body. This is also referred to as the real body. The long, thin lines above and below the body represent the high-low range and are called shadows, also referred to as wicks and tails. This right here is a filled body. Okay? This is also known as the real body. The shadow or wick is here, or here, protruding from top or bottom. It's just showing you extremes for the day, the highest high and the lowest low. Not every candlestick is going to have a wick from the top or the bottom. There are situations where you have neither. Situation where you have one out of the top and not one from the bottom, or you can have one out of the bottom and not one from the top. Clean that up. When the stock closes higher than its opening price, a hollow candlestick is drawn with the bottom of the body representing the opening price and the top of the body representing the closing price. Let me show you that. In this case here you have a hollow candlestick formation. Basically it looks white, but it's actually hollow. That's why you can see the lines of the chart running through them. Okay. Whenever you see a hollow candlestick, you know that the opening price for the period was here and the closing price was here. It wasn't basically there's buying activity going on. When the stock closes lower than its opening price, a filled candlestick is drawn with the top of the body representing the opening price and the bottom of the body representing the closing price. Here we have an example of that. Here would be the open, and here is the close. And we know this just from looking at it because it's filled. One of the common questions beginners often ask is, why is it that this filled candlestick is red and this filled candlestick is black? That's basically due to what the previous candlestick has done. In this particular case here, you have the opening price is here and the closing price is here. You know that because it's filled in. However, it's black because the closing price for this particular period was higher than the closing price of this particular period. So it's letting you know that, as well as telling you that you would close down from the open, but you're still moving to the upside here. In this particular case, you don't have that. You can't see the other candlestick, but based on this color, I know that the close of this particular period was lower than the previous close on the last period. The same color coordinating information is portrayed on this particular candle. You'll see it in a moment when I show you the other chart, but here the close for the day is here, which is higher than this one. Therefore, this hollow-bodied candlestick is actually outlined in black. That black telling you that the close is higher than the previous close. However, if the situation were reversed, where the close were actually down here, for example, then you would have this whole candlestick would be, still telling you the same thing, that you had a situation where the close was higher than the open. However, it would be outlined in red, telling you that it is closed lower than the previous close. Let me show you an example of that. Here's our example. You can see that the close of this particular day was here. And the following day, we had an open here and a close here. However, this is outlined in red because it's showing you that the close is less than the previous close. In some rare cases, you will have situations where the real body of a candlestick is so minute, or maybe even not even there completely, and it will simply look like a plus sign. In this case, we have a very small real body from showing you that the open was here and the close was here, very, very small. But in some cases, you will have the opening price and the closing price dead smack on the exact same point. In those cases, you will simply have what looks like a plus sign. It will just have no real body to it. Those are referred to as dojis. Okay, now we're looking at a 3-month chart of Bank of America's stock price, and you can see all the varying different types of candlesticks in play here. You have the bullish situations where the opening price was here, the closing price was here. You'll notice that there's no wick protruding from the top there, telling you that you closed the high of the day. You have the wick or shadow or tail going down lower here, showing the low of the day was at 512. Here you have a situation where you have a very bearish day. The open was here of the real body, the close is here. There's a very small wick protruding from the bottom there. This is obviously a close less than the previous period, therefore it is filled red. Here you have a situation where you have closed higher than the previous period here, but it is closed down from the open. In other words, price activity opened higher than it closed at. Here you have examples of dojis. It looks like a plus sign or a cross or an inverted cross. These situations are telling you that price activity closed at the same point that it opened. Here we see an opportunity or an example of a situation where the opening price was lower than the closing price. However, it closed lower than the previous day. Therefore, the hollow candlestick is outlined in red. Typically, situations where you have a close lower than the open shows that you have selling going on. It's bearish, and it should be considered a negative sign if you're long. In situations where it's inverted and you have a situation where the close of the day was higher than the previous or the day's open, then it's bullish. And it's considered a good sign for those who are long the stock. There are many, many different particular patterns and combinations of patterns that can be read from technical analysis of candlestick formations. We have many videos covering all these different elements. We're not going to put it all into one video, it would be too long of a video, but those elements are on our free website at perfectstockalert.com right there. Hope you visit us. God bless, take care, see you in the next video. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.